Good day, and welcome to the Q4FY22 earnings conference call of Data Patterns India Limited, hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Monali Jain from Go India Advisors. Thank you, and over to you, ma'am.
Thank you, Stephen. Good morning, everyone, and welcome to Data Patterns India Limited earnings call to discuss the Q4 and FY22 results. We have on the call Mr. S. Rangarajan, Chairman and Managing Director, Ms. Rekha Rangarajan, Whole-Time Director, and Mr. Venkat Subramanian, Chief Financial Officer. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that company faces. May I now request Mr. Rangarajan to take us through the company's business outlook and financial highlights, subsequent to which we'll open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Monali. Good morning, ladies and gentlemen. And I thank you for joining us early today for our full year's earnings call. I hope you had seen the results presentation which has been uploaded in the exchanges and on our website. Indeed, FY22 was a landmark year for Data Patterns. We successfully completed our IPO in December 2021 and have utilized the proceeds from the listing to repay our debt and create additional infrastructure. I'm happy to say that today we are a net zero debt company. While Venkat will take you through the results, I would briefly touch upon the execution strategy, order book development, and our future outlook. As you know, Q4 is still a significant quarter for us, and we've had many critical contracts to deliver this quarter. Over the last 2 to 3 months, as you're all aware, we are all quite stressed because of the supply side constraints and the shortage in the IT market. We had to work diligently to overcome this constraint and fulfill all our commitments. We are taking additional steps to address these constraints, pre-order early, and see that the requirements for next year, the orders in hand and expected orders are delivered in time also. Our order book has grown steadily, and we have now shown growth in all categories. The strongest growth has been in the development order book, which grew nearly 4 times to 121 crores in FY22. Some of the major orders we received in FY22 are from DRDO and BEL for radars to the tune of about 60 crores. The next big category was Avionics, where we received orders worth 45 crores. The other categories like communication, electronic warfare, and fire control systems, also we have received orders worth 29 crores, 27 crores, and 18 crores respectively. The important thing is these are all orders which can scale to multiple systems. The good thing also happened last year is that some of the orders we received last year, we have delivered. For example, the communication system or radio, a very modern radio for fighter aircraft has been delivered and they are undergoing flight tests now. Similarly, what we delivered on a radar and airborne radar have undergone flight tests in Dornier. So there are a number of success stories which we expect that will lead to additional orders in the years to come. Is now a very well-recognized company as a product company and is known for its R&D strengths, engineering, and execution strength. We have built a very strong competency model, right from building blocks to end products and also future products which will give us the growth and also an edge in execution in the years to come. While we developed in-node R&D, design and engineering capabilities, we need to expand our manufacturing facilities to achieve scale. We've utilized the IPO proceeds to expand our manufacturing facilities in Chennai and are setting up additional SMT lines and testing infrastructure. Accordingly, we will also increase our order inflows and are targeting to bid close to nearly 2,000 to 3,000 crores of additional orders in the next 2 to 3 years. These are all order pipeline based on already delivered contracts in the last few years, which we expect will come into production orders in the coming 2 to 3 years' time. More importantly than what we have done, also there are a lot of macro factors supporting a strong growth outlook for companies like us. There is a strong trust in Make in India focus in the defense segment. You are aware that over the last few months, government has been cancelling most of the government-to-government import procurements and ensuring that it is all redone with the Indian system and bought in India. There is also a higher budgetary allocation in defense with a 10% year-on-year growth in the overall budget. This ban on defense equipment imports gives us also, along with a strong capability to build end systems and R&D which we do, gives us a confidence that we can achieve scale in the coming years. We believe that we should probably do 25 to 30% increase on the previous year for FY23 and also maintain a healthy EBITDA margin of around 40% plus. With this, I hand over to Venkat for his comments.
Thank you, sir, and good morning, ladies and gentlemen. We are happy to inform you that we have delivered a solid year and quarter in FY21-22. I would like to take you through the financial performances for the quarter as well as the year which has gone by. Our revenue for Q4 has gone up by 9% on a year-on-year basis from 170 crore, driven by strong growth in development contracts. Production revenue also grew to 102 crore, contributing 60% of the total revenue of the quarter. Gross margin for the quarter stood at 65% and EBITDA at 51%, driven by strong operating leverages. Revenue on a yearly basis, FY22 stood at 311 crore, up by 39% year-on-year, led by robust growth in all three segments of contracts. Development revenue rose highest in FY22, contributing 25% of the total. Gross margin for the full year was at 72%, expanded by 375 basis points, led by timely receipt of contracts and efficient execution of the same. We paid back the entire loan of 26 crore, both long-term and short-term, and spent 38 crore on capital expenditure in FY22. The overall working capital days improved to 329 days in FY22 from 355 days in FY21. Improvement led by better management of receivables and favorable mix in revenue. Inventory has gone up in FY22 due to additional stock of raw material for future requirements. We are also happy to inform that the company has recommended a dividend of 3 rupee 50 paise per share at 19.3% payout ratio, which is subject to approval by the company shareholders in the AGM. Thank you. And now with this, we will open the floor for question and answers.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Very good morning, sir, and congratulations on the great set of numbers that you reported. Hello.
Thank you, Sandeep.
Yes. So first question is pertaining to if you can share what was the share of single vendor contracts revenue that you have booked in FY22, and how does that contrast with your FY21 number, and where do you expect this single vendor contracts revenue to head forward in future for FY23, please?
Okay, I don't know the exact split of single vendor to overall contract. Maybe I can send it across to you by end of day today. But if you take the contracts, the last FY21-22, whatever contracts we booked, most largely will be single vendor contracts. There are a few development contracts which has come. These will be open tender contracts or limited tender contracts in radars and such systems from LRD, DRDO. Those are will be won on single on L1 bid. But largely, a large percentage of the contracts would be on single tender contracts because these were based on end systems where many such companies have to get together to make a system. Since we built up a competency and a product program, a number of these contracts came on a single vendor contract. There's a large portion. The exact ratio I will get you by end of day.
Sure. And so your presentation talks about all of these large orders, the BrahMos, FCS, Avionics, the RWR systems, Elint, and the others. So based on these large orders, what contribution they should have overall when you're guiding for inflows for next year of close to 500 crores? How much of value of each of these orders can contribute to? And basically, we just want to understand how much contribution will come from larger orders, which we should monitor, and then balance, of course, can be split in multiple small-sized orders.
See, a large portion of our order book and execution for FY23 will be from radars. We have about more than about maybe 200 odd crores orders left from the precision approach radar. We expect to bill about 100 crores of that from the existing contracts. On top of it, we have some development orders which we have taken from DRDO on radar subsystems, a large portion of radar subsystems. That will be order of another 40-50 crores. Those also will get delivered during the course of this year. And then we are also looking at some additional airborne radar order based on what we already delivered, which is flying now or tested in Dornier. We expect some new variants of that. So another 25 to 30 crores of order will go on radars. So radars will be a large portion of our sales. The second area where we would be, substantial contribution in sales will come from electronic warfare. We have delivered a number of systems. Last year we delivered what is called as a Darashakti, which is the next generation communication intelligence systems. Very, very small, very compact. First of a kind in India was delivered, and there is going trials now. Based on that and whatever we delivered on radar warning receivers and electronic intelligence for airborne systems, which are already going flight trials, we expect number of contracts to also happen this year on single vendor basis for more of platforms to be outfitted with our equipment. So that is going to be a significant value proposition for the company. We also delivered some communication systems for fighter aircrafts. We expect some repeat orders to happen this year. They are also undergoing flight trials. It is going to undergo about LCA flight trials and other fighter aircraft flight trials this year. So we expect some additional orders to also happen for both ground and air communications. The other order we're expecting is, BrahMos has booked the export order to Philippines. Back to back, the fire control system order also we're expecting. We already quoted. We expect the contract to happen now. The next major order book we will get, maybe not execute all of them this year, is in the LCA Mark 1A program, where we do the mission computer hardware for the system aircraft was designed by us. So we expect some contracts to happen. We already got some contracts last year, which we're executing this quarter, and more orders are expected this quarter. The second area is the cockpit displays for the LCA Mark 1A, which we designed long back, and additional orders are expected. It is under negotiation, so we expect more orders to come. Whether it will be delivered this year or next year, we do not know, but orders are expected. So we expect a fair amount of contracts, about 400 crores to 500 crores worth of orders we expect this year. On top of it, we are also now quoting for very large systems, other than subsystems and equipment. We're also looking at full system quotations, which we are hoping to get some very large orders as we go along. So we think we are quite good in the order book, and these are all what has been done earlier, and some orders we're getting on development contracts also. But the large portion will be radars, followed by EW, then communications, fire control systems, avionics, and then a lot of other small orders which will make up some few tens of crores.
Understood. So, our next question is on the share of developmental orders that has increased materially in the order book to 25% now. Should one be worried about the margins that you will deliver, because these development orders typically have lower margins versus production?
No, that is not necessarily true. I've always made the statement. What we do is development orders, the gross margin remains the same. It's normally, I'm saying. Of course, it varies from contract to contract. And for certain strategic contracts, we probably, because we need to have positioned ourselves as the L1 bidder, we may have to quote lower on the gross margin percentage. But what really we do is we absorb development costs. That's what normally we do. And that is booked as revenue expenses. So as long as you're okay on the gross margins and the overall, we have the capacity to design and develop in the existing kind of overheads which you have, we're able to do that. We're still comfortable in building, delivering a bottom line value which you're talking about. That is point one. Point number two, a number of contracts, two things are happening. Once we increase our revenue, our operating costs don't go up as a percentage of revenue growth. It doesn't happen. So it then comes into EBITDA. So a good mix of production come development orders is always important to see that we get the growth which is necessary in revenue, maintain the bottom line over overall percentage, and also allow the development contracts to become the foundation to build larger production contracts in the years to come. So it is always a good, healthy mix to have both of them and not have only production contracts, because we are now in a growing market. We need to build products. You understand that India, relies very largely on imported electronic equipment. There is hardly any company who builds that equipment in India. We want to build complete equipment in India. So that means there is an enormous landscape on which we can paint. So we need to get the development, get the building blocks up, go closer towards building complete equipment ourselves, that the IP belongs to us. That's where the scale can happen and the growth can happen. So I think we need a mix of both.
Understood. And one last question from my side is on this recent third list of ban on imported equipment, as well as another list of subcomponents that was announced. Are there any specific areas there which you can highlight and possible opportunity size that can come in your addressable market? If you can talk with some size and numbers over here, if you can guide us. And secondly, there is this competitor of yours, Alpha Design. I think when we look at their order book to sales ratio, they are more than 9,000 crore of order book with some 400 crore of sales, and they are very much in the same field. Why is there such a big divergence? Are we seeing some shift or some increased competitive intensity from such kind of a competitor? If you can give some brief comments on that also will be helpful, sir.
Okay. The first part of your question is a large part of this ban on imports is some part of it is what DRDO has designed. Wherever DRDO has designed areas where we also participate in those products, then the ban helps us to say that the services will buy once production at least orders from PSUs or directly from organizations like ours, in which case the scale and the opportunity happens. I can't give you a percentage on the ban because it covers a whole range of products, from mechanical, ammunition, etc., etc. So really, we are not there in all the areas, and we are in electronic parts of and subsystems of a larger equipment. So we can't give you a percentage and a value proposition there. But only thing that, yes, we will contribute towards doing certain things. And we're also using the ban as a leverage to try to build some products which is uniquely positioned in India. Helps us to get a differentiation or a differential positioning in the market, so that we get a better IP and a better value per dollar or rupee which we sell in India. So this is the two things we're doing. It is good that this is happening and more made in India solutions are looked at. So this is first part of the question. It is good, but we can't give you specifics on numbers. As regards second part of Alpha, yes, Alpha has done well. They've booked a lot of contracts, as I know, the last 2-3 years' time. But their business model and our business model are different. While we design in-house all of the subsystems in India with IP belonging to us, work with DRDO, build the equipment and grow, they have worked with a lot of foreign companies to build end equipment along with them on a technology transfer basis, and then getting orders in the open market in MOD and other sales situations. That market model is different. Our market model is different. You would see that on revenue to EBITDA to gross margins to bottom lines. We are a more IP-driven company. So you see that the value proposition of the bottom line and value add which you do in India on our products is far higher than a comparable ratio which you take with companies like Alpha. There are a number of companies who are in this field, large corporations like Tata, L&T, Mahindra, all of them are in the competitive landscape because they want to be equipment players and system builders. So all of them tie up with foreign entities to build a local competency matrix to see that we address the requirements, which is becoming large. The market is becoming larger, the opportunities are becoming larger, and I think that's exciting. For companies like us, when we do things in India ourselves, then we become a cost competitor because a lot of IP gets generated here. And we get, we will be able to address the requirement, one. Second, Government of India has made it very clear that there has to be minimum 50% value add in India. When you do such kind of requirement, then it's going to be very difficult to buy and integrate systems and do 50% in India. You have to necessarily do design in India, do a lot more development in India to meet the 50% target. So all this will drive towards more made in India solutions. And we are actually positioning ourselves to that. Built up an organization last 2 decades of development effort towards trying to do value add in India and only import raw material or components, which is not made in country, like electronic ICs and all that. Rest of the design is done here. So the market model is different. Each approaches the market differently. We have approached it as a completely truly made in India solutions designed in India. I think enormous opportunities are there for us. And we are expecting a lot more orders to happen in the coming years because whatever we've developed the last 2 years back, once they get into production, we'll get a few thousand crores of contract happening. But the good advantage thing is when such contracts happen, the margins which we originally quoted with continue to remain there. So we'll give you a good bottom line and EBITDA margin, which will help us build more equipment in India and build larger scale. So that's the kind of an approach we have taken and worked on it for many decades. We continue to do design in India solutions.
Understood. Thank you so much, sir, for taking this question.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Thanks for giving me the opportunity and congratulations on a great set of numbers. I wanted to understand in your opening remarks, you mentioned about order inflow to the tune of 2,000 to 3,000 crores that will come out for bidding, which will come in the production phase. So this number that you are mentioning, is it only for you or is it at the industry level? And if it is at the industrial level, then how much will be for us? And what is the broader split of these orders? That was my first question. And second question was on the competitive intensity side. How do we see ourselves versus competition to the players of other listed players such as Astra or Paras or Bharat Electronics for that matter? How should we understand that?
Okay. See, what we're talking about 2,000, 3,000 crores is all pipeline orders which we expect to come our way, which will be largely single vendor orders because these are all based out of contracts already we developed 4-5 years back and delivered to customers, which have gone to trials. And based on the trials finalization, now the inquiries are expected from MOD. The MOD goes to BEL or HAL based on the technology transfer agreements with the DRDO, whatever we design. Then back to back we will get contracts. We are only talking about these kind of contracts in excess of few thousand crores. We expect the contracts to happen. The timing may vary. So that is why we said 2 to 3 years we will get the contracts going ahead. On the constitution of the contracts, largely this is going to be radar driven, where a lot of products have been designed and delivered by us in 2014, 15, 16, 17. And even today we're doing a lot of development orders for radars. So that will be the bulk of the kind of contracts in the overall regime. Second area is going to be in electronic warfare, where we've done substantial amount of development design and delivered. So we expect these 2 areas to be the 2 top areas out of this 2,000-3,000 crores or 4,000 crores we're talking about. Then the communications, other platform-specific hardware which has been designed by us. So this is the first part of your question. On the second part on competition, India is a large country. There's a lot of competition across the profile. Competition matrix varies from MOD tenders or services where they buy end equipment. When you buy end equipment, naturally there will come from companies like L&T, Tata, BEL, etc. Quoting in that area. And they tie up with the foreign companies and then try to build more in India and be competitive and address this market. So these are for large contracts and large systems. The second area of competition is where development design is done in India. That is in some parts in HAL tenders, some parts in large parts in DRDO tenders, where the subsystems and parts are contracted. There are a number of companies like Astra, Microwave, or such companies, and many more such companies are there who compete with us in those areas of competency. So competition arises in two areas. The differentiation we try to do is try and build more in India. For example, if X company makes a good in certain areas of products, they have to buy Y parts from outside India or to make the end system possible. We try to make the X and Y in India or the Z in India. So all parts are designed in India. With the result, we can provide a competitive landscape in the sense that our cost on raw material cost can be lower. Of course, there's a lot of development costs toward developing instead of buying. We design from scratch. But what we've done is we've built building blocks and reuse the building blocks. So many years we have tried to build the building blocks and reuse them. And this covers the entire spectrum of electronics, including power and high voltage and microwave 40 gigahertz. So we do that. This is a difficult model because it takes a long time to design, develop, and build products. But we started a journey ahead many years back. So today we have a situation that it is helping us to be competitive in a landscape where people buy, design, integrate, and build, where we do design and build ourselves, so that we have a better raw material to sale price margin, where we can have a competitive cushion to sell L1 if required. And also because since it's been redesigning of existing products, our timeline to deliver also is far better. So this is where the differentiation is. We hope to differentiate further as we go along and build end equipment and compete in the large markets.
Sure, sir. Thank you very much for such a detailed answer. And just an extension to the earlier one. I mean, we are expecting roughly 2,000 to 3,000 crores of an inflow or largely on the production side in the next 2 to 3 years time frame. So how should we see your company on the revenue and in the margins over the next 3 to 5 year period? Last question.
Yeah, see, these are all tender-based, equipment-based business, so we can't be very clear. Only thing I can say is, at the present rate, we are growing 25 to 30% year on year. We believe that is possible. Maybe we can do much better than that. So some of the larger contracts happen earlier. We'll be able to do that. What I can say is this: we have a pipeline which is large. We have a delivery model that and a competency base so that we can deliver the products. Since everything is designed in India, the setup infrastructure which we require to even test and validate is homegrown here. So we have everything in-house and it is internalized to us. So we can deliver. Even if you give me tomorrow 700 crore, 800 crore order, and our 2,300 crore order, we should be in a position to deliver over 2 or 3 years' time. We should be able to deliver because we have the process, in-house process to manufacture and test and validate and deliver. And design has been done by us. So we will scale 25-30% year on year in the next few years, definitely. Whether we can do better than that is depending on the order timing, when it comes. If it comes, we will do faster. So that is all I can tell at the present moment.
Sure, sir. Yeah, thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question and hope I'm audible. Just to sort of follow up on the previous questions of 20 to 30 billion of potential order inflow over the next 2 to 3 years. Just to understand the kind of investment, hypothetically, if this order comes in, the kind of investment that you would be looking in to sort of capture this opportunity, or is the investment already in place? The potential R&D spend that you'll be probably looking at. So, some contours on those, if you can kindly share.
See, what we have done is, till now we are an electronic manufacturing company. So we had a pick-and-place line, the test infrastructure to manufacture whatever is designed by us. Now the company is not only doing the electronic subsystem, we want to build end equipment. So towards that, we need different kind of infrastructure. So we are now doubling our infrastructure in terms of production capacity in electronic manufacturing testing. We put a lot of money on test equipment. A second pick-and-place line is ordered, and that is going to come in. So a lot of additional environmental test requirement for final validation and dispatch. We are already in the process of installing all of those things. Plus, we put one more 1 lakh square feet of infrastructure has been created. It will be ready in the next 3 months, where we have created a hangar space where we can bring in trucks, 10, 12 trucks inside the facility, outfit the trucks. We can bring 10 tons equipment, gantry. So we are creating a system integration space which was not there earlier. In line with the organization growth strategies, whatever we design as an end system, we should be able to design, demonstrate, at least the prototypes, few pieces which we will develop, deliver and deliver to the customer. Now this will form the basis for larger orders, a few hundred crores, 2,000 crore orders each order, if we're able to deliver end equipment. So we have created infrastructure to do that. Now that is the second part we've done. The third part of the question is, say, if you are getting 2,000, 3,000 crore kind of orders, whether the existing infrastructure is adequate or not. Now again, if it is going to be, let's say, Avionics, we get few hundred crores each of them, and we do some 500 pieces, 200 pieces, 300 pieces. All we need to do is some test equipment, which we need to do, because pick and place line, we will produce a lot more than what is necessary, so we can productionize it and deliver. But if it's going to be a very large system, so example, Ashwini radar or radar such, we need to get very large radars, and we need space, then we'll probably require a 10-acre land to put those infrastructure and facilities. So it's very it is dependent on the capex future. Is going to be dependent on the kind of orders we're going to get. All I can say is we have created the infrastructure for our scaling. We have the basic infrastructure to see that we produce whatever we have for the next few hundred crores or 1,000 crores of business a year. But of course, the incremental capex may have to happen depending on the kind of contracts and the time of delivery of those contracts. And what we typically do is, this is will be a percentage of the contract itself. So it will be funded by that contract, is what we believe, that we don't have to really create such large infrastructure in anticipation to contracts. I think that is not good, because the timing of the contract is not very in our control. So if it takes time, we will then put capex and wait, which is not a good thing to do. So when we get the order, we will create capex as and when necessary, if it's so demanded. And initial delivery, for example, we have a government facility for test and validation. We will utilize this for the first system. And in the process, for the second year delivery, we should be able to put the contracts, the capex necessary. I think we're comfortably positioned in terms of capex. I don't see very large capex outflow in the coming 1 or 2 years' time. And if it were to happen, it will be spent out of the contract, which we will get.
Okay, and what about employees, your resources? I could see there are 818 employees in the organization. So how does that bench strength need to be sort of ramped up to target, say, 1,000 crores of revenue and potentially 2,000, 3,000 crores of order book? What are the thoughts over the next couple of years? Which are the areas where you are sort of trying to augment your team? And also, what's the succession plan, if you can sort of briefly mention on that? Yeah.
See, today we have about 800 odd people working with us. More than 470 engineers are working. Again, if you look at ratio, it's very high engineering capability. This is again with respect to our approach to design. We do design upfront, complete design down up. So the engineering people will be far higher than the overall contribution of people. Second is our recruitment is on design development and the engineering capabilities. We have our own HR, which has been recruiting from fresh out of college. We go out and recruit people from college. We have a very strong in-house training department. So we recruit, we train, and deploy our people for our requirements. For the development team, we recruit some 100, 200 engineers year on year. This year, I think we are ramping up our recruitment plan because we're expecting large more contracts to come. So we need to be people ready. So there is a lot of emphasis towards recruitment and training, which we do in-house. We are not typically recruiting from outside for development engineers. Inside, we recruit from colleges. However, we are looking at project management and such requirements. We are trying to look at recruitment from services and other areas. That also is on to see that program managers are being recruited. Our own people are promoted to positions to take over. There's a lot of internal promotions taking place. A lot of training is happening. So training and skill development is a very important part of our overall process. So we do this. The third area is, we have out of 800 odd, we find 80 plus are in QA and QC. This gives us a very extremely strong backup on quality process. Everything is written down in our office. Homegrown processes. We have guideline checklists for almost every activity which we do. Now, this is important because, like you said, attrition is also part of the key because we are an engineering company. People come and people go. We get very good trained resources. So multinationals and large corporates in service industry, in electronics, recruit people from us. So this is something which we cannot avoid. So we are recruiting for attrition. We recruit for attrition and training. We've been doing this for many years. We continue to do. But we don't lose many people in the middle and the top management level because it's like a family-owned company. Everybody is very close-knit, very high level of ownership in the organization. So there is a lot of motivation, internal motivation to see that we build end systems ourselves. So there's a lot of belief within the company. So that is as part of the ethos of the organization. Yes, we are recruiting. We are filling up management positions. We are also looking at what kind of bandwidths we need to have at various levels and how do we address the bandwidth requirements. So that is all an internal process which is on, which is very relevant and current, and we are addressing that now. As regards, for me, it's a position, we just last board meeting, we made an executive director, my COO, Vijay Anand, has been promoted as the director on the board. So on succession plans, we have ideas what we want to do. This is being discussed in the board, and we're looking at every key employees within the organization and says what happens when we need more such people. So that also, the thought processes are on, and processes are in place to see that we recruit, train people for positions so that the transition can take place as and when it's necessary, and also to address scaling, which is bound to happen in the next few years. Yes, these are very valid questions, and we understand the importance of this, and a lot of emphasis and thoughts are going into trying to address these concerns.
Thanks. That's all from my side.
Thank you. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Thank you for the opportunity and congratulations for good set of numbers. Just a question in the presentation you have highlighted a seeker model. Can you give some details on what is the development of this product, where it is going to be used, and is the 2,000-3,000 crore order inflow which you have suggested also inbuilt this number within that, or it's outside that? Yeah.
No, I didn't understand the first part of the question. What did you say? I couldn't quite hear you very well.
So the seeker model which you have developed, could you highlight what is the status of that seeker model? Has it been tested?
Okay.
Looking at
See, that has been delivered. They are planning flight trials probably in a month or two. After flight trials, and then a missile trial is planned. Things are getting ready for the flight trials. So we have to await the results of the flight trials. And based on the success of flight trials, we hope that it will get inducted, and future production of BrahMos missiles will have indigenous seekers from us. But they have to get to go to flight trials. I think it's almost ready, the trial directives. So I don't know the exact date of the flight trials, but it is going to happen in the next 2 months. So the next 4 to 5 months, we should have some news on the trials and how it went. So that is the first part of Seeker. And based on the Seeker, modified Seeker, we actually delivered a radar for an airborne radar which flew in Dornier aircraft last month. There is a Dornier upgrade program for Navy. We hope that the next generation radars are selected for, Indian radars selected for that program. If that is what we do, there is going to be a sizable business from the Dornier upgrades, both on the radar as well as electronic intelligence. Both we have flown, and we need to make some additional systems to address all the specifications of the requirement. So I hope government takes the right decision and allows people like us to build the systems. If it happens, that will be a very good opportunity for us. The first time, full equipment is, airborne equipment is being designed in India and flown on military aircrafts. This is going to be a start because there is enormous opportunities in India for airborne systems, which we are continuously importing. We are not a single system which is designed in India. So if we can position ourselves as an equipment supplier, it will give us scale. So this is the first part of the question. It's just not the Seeker, but the building blocks we use towards it are probably can be so. We exported one version of that to South Korea last year. Last week also South Koreans were here for more such requirements. So we're also negotiating with them and discussing with them whether we can build some systems for the South Korean defense requirements. So full design being done by us. These are all small radars, probably $1 to $2 million kind of opportunities. But we wanted to build that competency model to see if export can be done of designed in India solutions. So this is it's just not one product. It spreads to many programs. On the second part of the question of 2,000 crores, see that like I said, a large part of it is going to be radars which has been, or part of the radars have been designed and delivered to DRDO, which has been accepted. So we expect repeat orders to come from Bharat Electronics. The second area is going to be again in electronic warfare, which again we have to get orders from ECIL and Bharat Electronics, so they are the transfer of technology partners for DRDO. There are other areas where we have made some inroads. For example, we won a contract nearly 18 crores for airborne communication intelligence and electronic intelligence upgrade for an aerostat. The aerostat is a very large balloon which is tethered and it goes up to the sky, where you are able to then get all the electronic intelligence data. We are trying to replace what is originally imported from Israel. We won the contract in open tender last month. I mean, the negotiations finished. We're expecting a contract to happen this month or next month, but the contract will be awarded to us. So like that, we're getting into some inroad where full equipment will be designed by us. We expect that these all will multiply with the first few pieces being delivered successfully. It will all multiply because the requirements are very, very large.
And sir, in the order inflow which you highlighted of 3,000 crores, you mentioned the EW suits. So where is the application for this EW suits? Largely, will it be in the aircraft, in helicopters? Where would this system be used?
Okay, presently what we have done, there are two levels of equipment. One for airborne equipment, there are two such equipment for airborne. For fighter aircraft, we call it radar warning receiver. That means any fighter should know what are the radars which is tracking you. So they will be able to immediately track the radar signals hitting your aircraft and position where the radar is coming from, what kind of signals, so you can either jam it, countermeasure it, or avoid it. So first the display has to be known. So we built these systems with DRDO, and some of them are flying. They're flying in LCA. They're trying to see whether it can fit with other fighter aircrafts. So we have some contracts, various contracts for various aircrafts which are under delivery. Some have been delivered and flight trials have started. This is the first part. Second part is the electronic intelligence. These are passive intelligence. It is put in helicopters and such requirements, where they monitor a very large spectrum of communication signals as well as radar signals up to 40 gigahertz to say where it is coming from, what is the electron happening, where the emitters are there, classified in the ground or in the air. So we know a map of enemy territory, what radars are happening there. So this is called electronic intelligence or signal intelligence. We first time built a complete system along with DRDO, including all the software, algorithms, everything. So these are all flying now. So all of them, when you go into some upgrade or new aircraft requirements, if this becomes a standard buy, then we're talking about few hundred crores requirement per sector, per helicopter or per aircraft, and which will be spread over many years of delivery based on the upgrade requirements. So a couple of thousand crores worth of contracts is possible in these areas, provided these are successfully deployed in all the aircrafts, flight trials that happen, and Air Force and Army and Navy, like what we've seen, then based on which the contracts can happen. But these are our seeding contracts, so this can be very large. The second area of electronic intelligence on the ground and to the Navy, till now we're not gone into the Navy, but we're expecting to go into the Navy in the coming year. But as of the ground, we have delivered all the communication receivers. We also built the electronic receivers for electronic up to 18 gigahertz, and we're now upgrading to 40 gigahertz. So these are all truck-mounted systems which goes in groups of trucks on our border area, listening in to enemy signals which is happening. So to understand what is the signal and if there is communication happening, decrypt the communication, who is talking the radio, can we hear the voice again, can we jam them? These are the things which goes in the electronic intelligence. We build a large part of these systems as receivers and electronics for this. Again, these are all expected to go into some numbers in the big programs. So that is where EW focus is as far as data patterns is concerned.
Understood, sir. Thanks for the elaborate answer, sir. I'm wishing you all the best.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Akshay Kotari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. So I just wanted to know what would be our working capital cycle in developmental orders? If you could give a sense of that.
Can you come again?
Yeah, what would be our working capital cycle in the developmental orders and the production contracts?
See, development order, the working capital cycle is longer because we first build a prototype. Let us say we 10 pieces have delivered. We need to first pieces to go as a prototype, then we have to go through full qualifications. It goes in 30 all different tests, from sandblasting to humidity to high temperature, low temperature, vibration. There are a lot of tests which has to be done and then put together and develop the system has to work. So we buy the material, go through the process development, get the acceptance, based on which the other production happens. So the development cycle, the working capital cycle is long, and also acceptance sometimes in some complex situations where ours is a part of the overall system, they have to integrate with the other systems, then acceptance takes a longer time and probably some consequent changes may happen based on the integration requirements. So this gets stretched sometimes. Production cycle is far shorter because we're very clear when the delivery is. The second advantage is going to be that there is no design development taking place in the production contracts. Everything is clear, acceptance is very clear. There is no change in terms of goalposts once you take the contract. The second portion on the production contract is that typically we get some volume production, whatever the volume you can stock in defense, but it is scheduled over many years. So there is a quarterly or a half yearly or yearly delivery, and the money flow is also there. So we can buy as per our requirements, produce as per the delivery schedules, and see if the collection is done after acceptance test. So the cycle is lower, but it can vary between even there we can vary about 6 to 9 months development cycle, production cycle, because component procurement is a long lead time components. Then goes to production also, retaining the production, go through validation, test, third-party QA also takes time, 3 to 4, 5 months it takes because production happens. Then delivery acceptance may take 2 to 3 to 4 months time because the third-party acceptance, it has to be field acceptance. So this is on the Army Navy Air Force. But if it's going to be production to HAL and BEL, or BrahMos, our acceptance happens in 1.5 months time. So 2 to 3 months time we are able to get our money. And all of these also has a advance clause, so we do get some cash flows in between. You see that everything is not actually funded by us and it is weighted. So the mix of combination is available.
Okay, that was helpful. Sir, you did mention about exports and work we are doing with South Korea and all these governments. Just wanted to know regarding the indirect exports, like if we are supplying radars to BEL, and we have been seeing that BEL is getting a lot of export orders and they wish to grow their export order book phenomenally. So could you give a sense of our indirect exports, like if we are supplying to BEL or HAL, so a part of that, would it be going to any other country?
At the present moment, I'm not able to visualize or give a number on indirect exports to BEL or HAL. Maybe at a later date. But presently, I do know the programs we're supplying to, it's all coming to India back against MOD tenders. So at the present moment, I can't give you a very clear answer to that.
Okay, sir. I'll join back in the queue. Yeah.
Thank you. The next question is from the line of Anurag Patil from Roha Asset Managers. Please go ahead.
Thank you for the opportunity. So, sir, as going forward, you will be targeting complete systems. So, with these larger orders, can we say our working capital can come down due to higher amount of advances?
See, advances are order specific. But what I can tell you is the working capital cycle will come down in the coming years because production orders become a large portion of the contract and development contracts a lesser portion. With the result, what happens? The one cash flow becomes quarterly. So instead of bunching up towards the year end, everything shows up as outstanding in the last quarter. If you find the quarter, last few years, we've been doing 80% on the last quarter. But last year, 21-22, you see that their quarterly profits were there. And the last quarter made about 50% to 55% of the turnover was done in the last quarter. But there was quarterly profits and quarterly delivery happened. This happened because we had a large number of production orders and their delivery could be done quarterly. Same thing will happen this year also. Though there is a piling up of contracts towards the end of the year, the pile-up is not 80%. In the last quarter. It is now gradually going to 40% and the rest will be done in the first 3 quarters. So this also because of production contract and the sizable visible order book which we have, we are able to deliver in phases. Our cash flows will become better, working capital will be better managed, and so net working capital cycle will come down. That is a major part of this, and more that happens. If you find as a percentage of the turnover and the working capital days, I expect it to keep coming down year on year.
Okay, sir. And second question, for development, production, and service, is it possible to share typical EBITDA margins?
Service will be more than 90% because it's only manpower. EBITDA, I'm not able to say
EBITDA on a
exactly.
segment level it will be difficult, but gross margin typically remains the same at around 65 to 70% in all the contracts. It doesn't really differ due to nature of the contract being development or production. The service contract typically about 90-95% is overall margin because it's only the manpower which is used. Otherwise, no.
Having said that, I think going ahead, we may take some aggressive positions depending on the strategic nature of the contract, where we will probably cut down the percentages and then bid. So the good thing is we have a margin profile. The good thing is we have order book, which gives you the previous margins to continue to go high EBITDA year on year, which we are projecting to you. This is all good thing. It also, now that we need to scale the company and grow into strategic areas, we may take some aggressive positions going ahead to see that we need to scale the business to make it 1,000, 2,000 crore kind of business. So we need to get the initial positioning inside. So since we have the headroom, competitive headroom on pricing headroom which we have, we may aggressively quote also. So this is going to be order specific, competition specific, and strategy specific for the company. But you can't really split it in these three modes. It's more in terms of respect to competitive profiling, competition, and strategy.
As an organization, we are confident of sustaining the 40% plus EBITDA margin.
Fair enough, sir. Thank you very much.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to one per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Narendra Malshekar from IIFL Securities. Please go ahead.
Hi, sir. My question is, you mentioned about supply chain constraints and our raw material availability issues. If you could elaborate on the measures taken by you to tackle these shortages, and how will this impact our execution, say for large programs like precision approach radars, etc., for FY23?
Yeah, what we have done, if you see our balance sheet this year, you'll find the stock holding has gone up by about 30-40 crores compared to previous year. What we are doing is, because of this last minute not received components, it may affect our production schedule, so we are ordering ahead now. Earlier we used to order just in time, so to reduce the inventory holding, but now we are not doing that because last minute surprises are happening on some components. 98% we'll have, 1% doesn't come. We still can't ship. So we're ordering ahead. That is one thing which we're doing. Second is some of the orders which there are component issues. We're repositioning delivery delays for 3 years, 3 months, 6 months, and then see what is it we can deliver ahead of time, because we have the luxury of contracts on hand. We can play around with some orders and see we can deliver ahead. This is another thing to ensure that the deliveries are going as per requirement. And the customer also understands there are issues in components. It's not really that we are delaying, but there is a genuine problem in the market. Everybody understands that. Of course, they don't like it, but they understand it. The third area what we're doing is where supply delay is going to be very large. For example, it's 52 weeks, 75 weeks, 100 weeks, if they say, I need to deliver it. We're also taking a position of redesigning some of the hardware to see that available components are put in. Wherever it's possible that redesign is allowed by customer, we redesign some of the parts to be available parts. So with a probably 3 to 5 month delivery delay, we're able to dispatch the consignments. So all three measures we're doing. And also we continue to say with the future orders we're expecting. Fourth thing we're doing is whatever expected contracts, single tender contracts are going to come. Maybe it will take a few more months to get the order, but then I can probably deliver it ahead if we pre-order those components. So we are taking, marketing projections and commitment from marketing to create work orders to see that component orders, or at least long lead time component orders, are pre-ordered. So we're doing a number of measures to see that our whatever targets we set for ourselves is not really slipped.
Thank you, sir. All the best.
Thank you. The next question is from the line of Vijay Goel from ICICI Securities. Please go ahead.
Yeah, hi, sir. Good morning. I just wanted to understand one thing. As you have mentioned in the presentation, that key orders in the pipeline are avionics for LCAs and for next generation software-defined radios for LCAs and Sukhoi 30 upgrades. So just wanted to understand this avionics opportunity for us is only for LCAs or it includes helicopters also like LCH or LUH? And if you can help us understand the total opportunity in avionics space. And my second question is, you mentioned in one of the presentations that 2 crores per aircraft opportunity in software-defined radios. So if I assume, 83 LCAs and 270 Sukhoi 30 upgrades, so roughly 350 numbers, so 2 crores per aircraft is so 700 crores opportunities there in this. Is my understanding correct?
I tell you, Vijay, I couldn't hear the first part of the question because your voice is breaking. Can you just give me a short question so that I'll be able to answer?
Sir, actually, what I was saying, I just wanted to understand, in avionics space, is this opportunity for avionics for us only for LCAs or it includes helicopters also, like LCH and LUH, which HAL is producing? So,
okay, let me give you a broad answer to that. See, while what happens when you develop something with DRDO, it is easier to test and validate it in the DRDO aircraft, which is LCA. Okay, so that is what first we do. And also some Dornier and things like we validate the systems with DRDO. But the opportunity is not necessarily LCA alone, because even for LCA, there are imported equivalents which is already considered and applying. So when we are trying to build a system here, we are trying to look at how indigenous systems can fly with while in competition with the imported systems. So that is what we're doing. The opportunity is not just LCA, the opportunity is for everything else. It can go to Dornier, it can go to Sukhoi 30, it can go to MiG-29, it can go to other helicopters of LUH and LCH. So all the opportunities are there. As a matter of fact, HAL also is looking at how to reduce or improve Indian content in all their aircrafts and helicopters. So there is a need, and government is pushing them to increase content. So obviously, when we have a choice where I meet international specifications and then it is all made in India and a lower Indian content, there is also there is a hope that we should be able to convert those opportunities into real contracts. But these are all work in process. We need to do this. The opportunities are real. The opportunities are large. It is a pan-all aircraft, but we need to go over them, test, validate, get customer acceptance, and then go. There's a government push, and we're doing push from this side. So as long as everything works out and satisfactory, yes, the size of business is very large.
Understood. And sir, one more thing, just wanted to understand, and you mentioned in one of the presentations that 2 crores per aircraft opportunity in software-defined radios, next generation software-defined radios. So, assuming this 83 numbers of LCAs and 270 numbers for Sukhoi 30, so, are we saying that, 700 crores of opportunities only from this software-defined radios?
See, this is a large opportunity. Presently, we are importing it from Rafael of Israel, and our service is quite happy with the product performance. So it is up to us to actually give an alternative, prove that this product is as good or better than what they're importing. Once that is satisfied, there will be support from the services, the users, because users have a requirement and they ensure that we meet their requirements. So we are working towards meeting the requirement. Jointly, we're working. We've delivered the first pieces. The flight trials have started. Air Force is getting involved to look at the flight trials. So in the next few months, we'll know how it pans out. And we will, I'm sure, address all their concerns if it were to happen. I think the product is very good. It meets and exceeds specifications. One-on-one. Plus, it also has Indian encryption, which is not there with imported radios. So we have done our portion of the job. Now DRDO has to flight test and validate it. Once that is done, whatever opportunity you're saying is possible. But will it happen today, tomorrow? I don't know. But there is an opportunity, there is a pipeline, and we need to address the pipeline. The product has been designed and delivered, and it is going to flight test now. The opportunities are very real. Yes, there is a large opportunity, and that is why everybody is competing in that opportunity.
Understood. Thank you, sir.
Thank you. A reminder to the participants, please limit your questions to one per participant. The next question is from the line of Kenil Mehta from Omkara Capital. Please go ahead.
Hello, sir. Are we going to partner with BEL and HAL for Indianizing their LIU subsystems such as EWS suite for LCH and ILH, line interface and detector unit for VIDAS, and PLDRO for RF seekers? And also the thing is, due to our existing building blocks being capabilities being in existence, do we have competitive advantage over other players in bagging these orders in next few years?
I can't directly answer this because I have to be specific about the requirement. You made a general requirement on BEL, HAL, CW and parts of indigenization. I can give you an overall answer. On a competency matrix, we are very up the hierarchy with respect to competition, especially on the EW. We build everything on it. If you look at the electronics on the EW, we build from processor to RF microwave to all the domain emitter classification, identification, software, algorithms, and we do this for all platforms. So we have a competency matrix is unmatched as of now in India with respect to competition. So if you take it as if that is the only thing, yes, we have a competitive edge over them. But that may not be the only thing because they may also offer something from a foreigner, made in India solutions. This is already flying. They may have other areas because I'm giving a flight worthy system already, which is already flying in Israel. Maybe the customer would like it. So it's not just a competency model or a capability model. It is also on the market model and what they look for. But what we are trying to do is, from the competency model, we're trying to push the market to get a competitive edge. Yes, that's what we're trying to do. And DRDO is supporting us in this program because it's a joint development effort. So they are also invested in the program. A lot of money and effort has gone through all of us. So we expect that at the end of the day we'll be successful because the products are international quality.
And also just one more question. Can I squeeze in?
So sorry to interrupt, but we have participants waiting in the queue for their turn as well.
Okay.
Thank you. The next question is from the line of Ritvik from One Up Financial Consultant. Please go ahead.
Yeah. Hi. Thank you for the opportunity. So just one question. We are looking to scale up our revenues over the next 3 to 5 years, multifold. And you've mentioned in the presentation that our working capital in the medium term should be between 280 to 300 days. So how do we plan to fund this working capital? We have cash on the books which will be used for capex and working capital. So till when do you expect this cash on the books and internal accruals to fund the working capital, and then after what point of time will we require to raise money to fund our working capital, or can it be met internally?
Yeah, see, on the 283 crores, you say, I expect it to keep coming down with the years to go. The net working capital requirement come down. Point number two, we have advance against most contracts. So if you look at the working capital today, if you take, let's say my existing limit, or what we're getting now is say 250 crores, out of which fund limit is 25 and non-fund is 225. So most of the working capital which you're getting now is all on non-fund limits, bank guarantee limits for advance bank guarantee, security guarantee, warranty guarantee, etc. So that is a kind of a non-fund limit. The actual fund limit is much lower. Point two. Point three is since production is going to happen, production contracts are happening. Unlike earlier days, it's not going to be bunched up towards the year end. So we get quarterly revenue and quarterly delivery. So cash flow gets slightly distributed over the years. So that also helps us to reduce the overall working capital days, as well as see the cash flows are all be operational. Point number four, if you look at it, a gross margin around 65 to 70%. So what really happens is, and 15, 20%, 30% of the overall contract is covered by advances. So that also takes care of some of the working capital requirements in the company. So since there is the gross margins are higher and the bank guarantees are also there and fund advances are also there, I think we should be able to manage the working capital quite well. And all important thing is we are also earning a fair amount of cash end of the year. We are net cash positive year on year. So I think we are quite okay with funding working capital without a problem. I don't see any immediate need for additional funding requirement for working capital our fundability is very high. Even if there, bank fund is available.
Bank fund is available, and we have necessary gearing available through the financials.
That's sort of concern now.
Thank you. The next question is from the line of Jay Naik, an individual investor. Please go ahead.
Thank you for the opportunity, sir. Sir, I just wanted to understand our capability and opportunity for unmanned aerial vehicle side, and our strategic partnership updates, if there are any, with the Indian companies or the multinational companies that you spoke about in the last call.
On the multinational side, we have some kind of cooperation with Leonardo. We expect some. We are already exporting our signal processor for the airborne radars to UK. We've been doing that for a few years. Matter of fact, last month we dispatched 100 system to them. They're very happy. Throughout COVID, probably we're the only company we didn't miss a single delivery to them. Month on month we delivered without any miss. So they're quite happy. We are having some long-term relationship with them, and we expect to build that relationship further. They have recently winning a contract. Our systems designed for them has also gone to Predator, the UAV. So if India buys, hopefully we will have some parts of it coming to us in India itself. Now it's going across the world. So there are some opportunities internationally where we are going to address requirements with some of the subsystems we are doing. As far as Indian opportunity is concerned, Tata Advanced Systems is building their own UAV, surveillance UAV. We are also, getting some contracts in that for IFF to radio, to things like that. We are trying to push some. We are also discussing with them in other electronic intelligence systems for them. So we need to finally build an ecosystem in India with Indian equipment manufacturers. I think that will happen with the more Make in India solutions happening. So we need to also look at partnerships in the local area with larger companies and platform companies. We are attempting to do that, and some successes we've already had. Some orders, initial development orders we have, which are delivered this year. So we're trying to maximize one by one. We'll try to take off those equipment on the UAV markets. But we just started doing that. There are some UAV vendors in India, and we need to look at what applicable programs or products we can put on the size of UAV, because not all of them are large UAVs. We cannot accept weight and power. So we're going to look at what are their solutions, what markets, and see whether we can produce some of the or develop some systems towards that UV market.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Thanks for giving the opportunity again. So you mentioned that in production orders our working capital cycle is lower. If you could quantify that, and what level of benefit would we get when production cycle would kick in revenue for us?
It will be typically, overall working capital cycle will be, if you are talking about the collection cycle, it will be around 60 to 90 days, whereas in the case of development contracts, it will be substantially more. But on a scenario of entirely our revenue being out of production contracts, our overall net working capital cycle will be substantially lower from what it is today. It will be around 210 to 240 days. But considering our revenue mix, we are expecting it to be around 280 to 300 days. That's the expectation.
Because we also taking a lot of development contracts year on year, so that is also happening. So if the ratio becomes more production, the working capital days will come down.
Thank you. The next question is from the line of Janak Lotwala, an individual investor. Please go ahead.
Hi, sir. Am I audible?
Yeah.
First of all, sir, many congratulations for the strong set of numbers. My one query is regarding, can you throw some light on what kind of opportunities are we targeting in the export market and the collaboration that we have with domestic players? Is it in defense, non-defense, and maybe if there is some opportunity size that you can help us with?
No, I didn't understand.
Part of your question actually got lost. Can you please come out?
Yeah. Can you throw some light on the opportunities that you are targeting in the export market, the collaboration with domestic players? Is it in defense, or non-defense areas as well? And maybe if there is some opportunity size that we are looking at?
No, we are at the present moment working with defense customers. We have some business with Leonardo. We are looking at some South Korean business. We are also looking at some, German parts where we are designing some hardware. They're putting some software. We're trying to take it global. So some work is going on. We are also working with a jet company to take our products and combine their software to market it in Europe. So there are some processes which is on. We are also talking to some UK companies to see whether co-development is possible. But it's a bit early for me to give you numbers and revenue. But yes, there is some work going on. Already we're building some export from here. Of course, it's a very large part, maybe 5 to 7% of our business is getting exported. Maybe it will go up to 10% in the coming year. We don't know exactly what will happen, but we are talking to a number of companies. But these are all actually products designed by us, where the IP belongs to us, the IP is shared. These are not production-only contracts. So this is products designed for India or European markets.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to the management for their closing comments. Over to you, sir.
Thank you very much. Thank you for all participating in this conference. If any of you have any further questions, you can always post in India, and we will immediately respond to those questions to them. Thanks a lot for all of you for the patience and for the interest. Thank you.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Go India Advisors, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.